You ready? Okay, for this mock exercise, we're going to take a look at consolidation again, but this time we're going to make one slight change, and we're going to take a look at a share structure that's more than just preferred share, more than just common shares. So we're going to take a look at how would the consolidation process differ from all the other mock exercises that we've done. How does it matter? How does it differ if the subsidiary has more than common shares? They have preferred shares in this case. So let's take a look at the question called PET and SET. But before we do that, let's take a look at some principles or concepts. So we know that if the company, if the subsidiary happens to have preferred shares, and we need to be able to determine whether those preferred shares are owned by the parent or owned by third party. So we're going to assume that the preferred shareholders are owned by third party. In that case, then we would assume that they are part of the non-controlling interest. And the preferred shareholders will have claim on the preferred share capital. We also want to also allocate their proportionate share of the dividends and claim on current income of the subsidiary. And if there are any preferred dividends in arrears, assuming they have preferred dividend rights or cumulative dividend rights, we also need to account for that as part of their non-controlling interest claim of the subsidiary. Now, in addition, preferred shares may have redemption premiums, and if preferred shares are redeemable for greater than its cost. So we also need to incorporate that in calculating the non-controlling interest portion of shareholders' equity of the subsidiary if they happen to have preferred shares. So these non-controlling claims of preferred shareholders are reserved or set aside in non-controlling interest by reducing the equity available to common shares. So normally in the mock exercise that we've seen so far, it's always parent have a controlling ownership, and normally controls are done through common shares, and oftentimes these subsidiaries have just one type of shares. So in this example, the PET and SET question, you'll see that the subsidiary SET has more than common. So we need to be able to calculate how much of the shareholders' equity that we need to allocate to the preferred shareholders, and they become a non-controlling interest component of the company. Now, the basics concept of consolidation in this case does not change when we introduce preferred shares. It just requires a couple of additional steps, and we're going to see that through this question, where we're going to take a look at how much of that shareholders' equity relates to the preferreds as a non-controlling interest, and we're going to actually expand the non-controlling interest balance sheet and income statement calculation to incorporate those preferred shareholders. When there are preferred shares in the capital structure of the subsidiary, the total shareholders' equity of the subsidiary must be allocated among the interest of the various classes of shares on the basis of their applicable rights and preference. So we're going to take a look at that. We're going to see how we're going to do that with the PET and SET question. Preferred share owned by external shareholders are presented as non-controlling interest. All common preferred shares owned by parent are eliminated. So if the preferred shares are owned by the parent, then it's actually much easier because we'll just eliminate that in our consolidation, because the investment preferreds would be equal to the shareholders' portion, equity portion of the subsidiary. That's just a straight elimination. But if the preferred shares are owned by a third party, we need to classify them as non-controlling interest. So let's take a look at the question. So this question, let's see, it says on January 1st, PET acquired 800 common shares of SET for $56,000. So given the fact that there are 1,000 shares and we own 800, so we're going to assume that it's an 80% ownership. So I'll just like to use the word P&S, parent and sub, and 80% ownership. Now, the subsidiary account of SET has the following shareholders' equity. You can see that there's the preferred shares, and it looks like it's $4,000, no par value. And if you look at note 1, it says they're $1, and that's the dividend rate, and it's cumulative, and it's non-participating with liquidation values of $1.05. That means that if we decide to liquidate these preferred shares, we got to pay them out at $1.05, and there are 2 years in arrears. That's important to know. Now we're going to factor it into our calculation. Now, these are the following retained earnings sections of the 2 companies in year 5. So we bought it on January 1st. This is the activity during the year, and we're asked to prepare the consolidated retained earnings for year 5. So we're only dealing with 1 year's financials results here. Now, the additional question, Pat uses cost method to account for investment in SET. That's important to know. And any acquisition differential is allocated to patent with a useful life of 6 years as at January 1st. Neither company has any patent recorded on the separate books. So the first thing they asked us to do is prepare a consolidated statement of retained earnings for year 5. The second requirement, it says prepare an independent calculation of the consolidated retained earnings at the end of year 5 using a format similar to your textbook. So page 278, we're going to take a look at that in a minute. And C, calculate the non-controlling interest for the consolidated income statement for year 5 and the non-controlling interest for the balance sheet at the end of year 5. So we're asked to calculate the NCI for both income statement and balance sheet at the end of year 5. Okay. So we're going to come back to that question again, but let's do the first part. So we're going to do a purchase price allocation. So the cost, we know that we bought 80% is $56,000. And remember, we need to calculate, because we have control, we need to calculate the implied value. Under the acquisition method, the implied value is assumed to be representative of the 80% purchase. So it's $56,000 divided by 80% is the ownership. And that gives us $70,000. So that must be the fair value of the entire business. Now, we're going to take a look at the shareholders' equity. Of SET. Now, this is where it's going to be a little different from the other mock exercise that we've done. We've got preferred shares. I'm going to short form that as PS. The total of that is $40,000. Common shares is $20,000. And retained earnings is $30,000. So all I've done is taken them out and listing them exactly the way you see them in the question. Now, first we need to figure out how much of the shareholders' equity is attributable to preferred shares. So we know that the preferred shares, so let me just write this down. So number 1, preferred shares have liquidation value of 1.05 times 40. So we know that these preferred shares will be liquidated at $42,000. Then indirectly, we need to take $2,000 from common, because we know that this $2,000 of this is basically a 42 of that actually goes to preferreds. Now, common is 20. Now, we only want this part, right? We want the common share column. Now, with retained earnings, we got to figure out, so I'm going to put a little 1 there. We got to figure out for retained earnings, how much of that retained earnings goes to preferred? Well, we know that there are dividends in arrears, and that was for 2 years. So it's 40. How many shares? There's 4,000 shares times $1 dividend per year times 2 years in arrear. So there's 2 years here in arrear, and that gives us 8,000. So we know that of that retained earnings, 8,000 belongs to preferred, and that means that 22,000 goes to common. So preferred has a $50,000 portion of this shareholder's equity that belongs to preferred, and then common gets 40. And it is the 40,000 we're going to compare against to come up with AD of 30. Okay. And we know that it's allocated 100% to patent. We're told that. And patent has a 6-year life, right? So the amortization for year 6 is going to be 30,000 divided by 6 times 1, which is 5,000. So this is the remaining and amortized AD. Okay, so I just want to highlight this. I'm going to highlight this as number 2. And really what we're after is just this column. That's what we're trying to figure out. And that's the difference, isn't it, of the shareholders' equity. So we did this in many numerous mock exercises. We've done a lot of these, except with the introduction of preferred shares, we're going to allocate how much of the shareholders' equity belongs to or attributable to preferred shares. And these are the non-controlling interest. And this is how much is in common. Okay, so that's the purchase price allocation. So we need to move on to the next part. And if we have to calculate consolidated retained earnings, then we need to know what the consolidated net income is. So we need to calculate the consolidated net income. So we always start with, again, we've done many of these. So we start with PET profit, which is, we're told, is 30,000. Now, we're going to deduct, because remember they're using the cost method, so we need to deduct the dividends from set, right? Now, how much is that? Dividend from set. Well, let's take a look. The dividends that were declared according to the case facts, set declared 15,000 dividends. So $15,000 dividends. Okay. Now, we're going to first take away, we're going to less the preferred shares dividends, and we know that was 4,000 times $1 times 3 years now, remember? Because they had 2 years in arrear and the current year. So that would be that would be 4 times 3 is 12. That leaves us with 3,000, right? But we only own 80%. So that gives us 2,400. That must have been a dividend to PET. So that's why I am taking away 2,400. Okay, so this is an important calculation because we need to figure out how much of the dividends that we need to deduct from set, right? And that's what we need. Okay? Then that gives us 27,600 now. This could have been a much more complex question by including in there upstream, downstream profits. So in this case, we would always include, and we've seen this in the previous mock exercises, what if we incorporated intercompany transactions? And of course, we would adjust this accordingly. All of this is just adding that one extra step. Now, we've got set profit, and that was given to us at 20,000. We're going to deduct the patent amortization, and that was 5,000. We saw that from our analysis. That 5,000 is here. And that gives us, again, 15,000. And then we're going to add this to come up with the consolidated profit of 42,600. Now we need to separate this into controlling and non-controlling. So this is, let me start with non-controlling interest first. We know that the non-controlling interest is how much of that profit is going to be the preferred shares times 1 year, okay, which is 4,000, plus, right, the non-controlling interest is 20% of the remaining profit. So the profit is 15 minus the 4. So that gives us 11,000. 11,000 times 20% is 2,200. So that's 6,200. So it's these two numbers that we want. And therefore, PET shareholders is going to be the difference between the two, which is 36,400. So let me just highlight where I got these numbers from. So first of all, this 15,000 is this number here. So all I want is I want to be able to say how much of this 15 goes to, because this is the sets profit after I've adjusted for the amortization of the patent. How much of that belongs to non-controlling interest? We know that the first 4,000, because it's preferred shares, goes to them. Then we take a look at the remaining income and how much of that remaining income goes to the non-controlling interest. So the non-controlling interest represents preferred shares and 20% of common share ownership. And that's what I have here. Okay? Now, let's do part A, because that's part A. We haven't really answered part A yet. But now part A requires us to do a consolidated. Remember it says prepare consolidated retained earnings. Now that we've got the right element, now we can do that. So this is, again, proper heading. So PET, company, statement of retained earnings. And it's for the year ended December 31st, year 5. We start with retained earnings, beginning of the year. Now, that retained earnings beginning of the year should only be PET, because we bought this company on January 1st. So this is straight up only PET's retained earnings. Okay. Now we're going to add net income, and we just calculated that as 36,400, and that's this number here. The 36,400 is the number that I'm adding to it. We're going to deduct dividends, and the dividends is only PET. Okay, I got per schedule, only PET. That gives us 61,400. That's the retained earning end of year. Okay, so that answers the first part. Now, part B asked us to prepare an independent calculation of the consolidated retained earnings of year 5. So let's do that. Okay, so part B, let's start with PET's retained earnings. And we know that was 55,000, right? According to the case facts, 55,000, parents only. Remember, if this was an ongoing problem, then we would have to adjust that, don't we? For any downstream ending inventory profits that remain on ending inventory, only the downstream. But this question does not have any intercompany profits, just to make life easier. Now, we need to look at the set retained earnings. In set retained earnings, we know that they had beginning of the year of 35. So let me do the total here. Okay, so this 35 is this 35. Okay? Now what are we doing next? We've got at acquisition, what was the retained earnings on acquisition? We know it was 30. That's the acquisition retained earnings. That's 30 right here. Then that means that's a change since acquisition, which has a combination of income and dividends. And we have amortization of patent. And we know that was -5. So we know that there's 0 on retained earnings. It just happens to be 0 with the amortization. Now we're going to allocate this to common. So this one goes to common. And at acquisition, we know that when we did this, we had 8,000 of this that goes to, right, and 22 goes to common shares. So that came from our analysis. So this is -8, because we're going to subtract 0. Okay. And this is only for common. So this is 8,000 times 80% gives me 6,400. So add this up, I get 61,400. So this is the retained earnings consolidated at December 31st, year 5. And this is the same as this number. And this is the proof that this number makes sense. Now, moving into part C, it's asking us to calculate the non-controlling interest for both balance sheet and income statement. Okay, non-controlling interest for both balance sheet and income statement. So let's do that quickly. So let's calculate NCI, income statement. Okay, and I thought we did that already indirectly, didn't we? That's this number here. Okay, that's the 6,200. So we know that we've done that already. So let's do it anyway. So you've got preferred share interest, which is the 4,000, because that's their year. That's the 1 year's preferred share. So it's 4,000 times $1 per year times 1 year. Okay. Then we've got interest in common. It's 20% of 15 minus 4. That gives us 2,200. And that's 6,200. Now, NCI, balance sheet, very similar to what we've done in previous mock exercise, except we're going to add one extra step by segregating the preferred shares. So we know that preferred shares was 42,000. How did I know that? Well, we know that that's the liquidating value, right? The 42. Now I put a -2 here because I need to balance it out to 40. So this is the liquidation value. Let me write that down so that we remember where we got this number from. This is liquidation value. Now, common shares, we know there's 20, and retained earnings is 35. What about the unamortized AD? We know there's 25,000 left. How did I get that number? Remember we saw that, the unamortized AD is 25 right there. And that gives us 78,000. And this is at 100%, and this is at 20%. And this is 15,600. The sum of this is my balance sheet non-controlling interests. And this is my income statement non-controlling interest. And that's my balance sheet non-controlling interest. Okay, thank you.